Welcome to Chapter 24 Differential Analysis and Product Pricing. In this particular chapter, we talk about differential analysis reports that are used for different management decisions. We look at determining the selling price using the product cost concept, and we compute relative profitability of products in the bottleneck production processes. So, differential analysis is a managerial decision making that involves choosing between alternative courses of action. Which one of these do we want to do? And although managerial decision making processes vary by the type of the decision, there are some basic rule of thumb steps that take place. We have to identify the objective of our decision. Most of the time, this is going to be to maximize income because, after all, we're in business to make a profit. There is identifying alternative courses of action. What are our options to do that? Then we have to gather all the pertinent information for each of those courses of action and prepare differential analysis. We make our decisions, and then after our decisions are made and things have been implemented, we will review, analyze, and assess the results of those decisions to determine was that the correct decision or do we need to make some adjustments? So let's use Bryant Restaurants Incorporated, and they're trying to decide whether to replace some of their customer seating tables with a salad bar. Salad bars take up some significant space, so they will lose some seating in order to accommodate it. They engage in a differential analysis, and we're going to start seeing that here in the following slides. So, step one obviously is to increase their income. They want to be able to offer a salad bar, charge it at some particular rate. They expect so many customers to take advantage of the salad bar, perhaps bring in a new demographic. Now, their two courses of actions are to use the floor space for existing tables, leave things as they are, or replace some tables with a salad bar. The next step is that they gather information and perform a differential analysis. Some of the information that they might want to look at is how often are they seated at capacity? Are those tables really necessary in order to generate the current level of revenues? If they get rid of those tables, would that have any impact on other revenues? And any costs that are normally associated with operations. They'll adjust those to the new amount of tables and then add the salad bar for alternative two. So this is the data that they came up with. They would have revenues of 100,000 with costs of 60 and income of 40,000 if they left things as they were. They used the existing floor space for existing tables. And if they added the salad bar, this is what their belief is. They would have 120,000 in revenue, an additional 65,000 in costs. So that would bring them to $55,000 worth of income. So we use this specific information to perform the differential analysis. This can also be called an incremental analysis. It's going to look at the difference in the revenues and costs in order to determine the impact on income based on these two alternative courses of action. Now, you could have two, three, four alternative courses of action, but in this case, to keep things simple, we just have two. Basic definitions, which you should already be aware of, are differential revenue is the amount of increase or decrease in revenue that is expected from a course of action compared to an alternative. Differential cost is the amount of increase or decrease in a cost that is expected from a course of action as compared to an alternative. And differential income or loss is the difference between the differential revenue and the differential costs. Differential income indicates that a decision is expected to increase income. A differential loss indicates that the decision is expected to decrease income. So we'll start looking at the actual differential analysis. It is prepared in 3 columns, where positive amounts indicate the effect is to increase income, and negative amounts indicate the effect is to decrease income. We'll actually be looking at one of these in the next slide. Just be aware that the first column is revenues, costs, and incomes for alternative 1, in this case, maintaining floor space for tables. The second column is the same for alternative 2, revenues, costs, and income, in the fact that if we were to replace some of that floor space using a salad bar. And the third column is the difference between columns 1 and columns 2. So this is revenue, costs, and incomes compared between the 2 alternatives. So here's the representation of what I just described to you in words. You'll see revenues, costs, and incomes, and what that differential effect is. So for alternative 2, we would have $20,000 more of income. Comparing alternative 2 to alternative 1, we would have an additional $5,000 in costs, so it's a negative because it's expected to reduce income, giving us overall a difference in income potentially of $15,000. Now that we have all the data aggregated, we've done a differential analysis, we have to make a decision. Based upon that analysis, uh, Bryant Restaurant should decide to replace some of its tables with a salad bar. Doing so will increase its income by $15,000. Now they have put in the salad bar and it has been going for a while, so they need to take a step back and review, analyze, and assess the results of their decision. So, periodically, what they're going to do is they're going to look at what their actual revenues and costs are. If they differ significantly from those that they forecasted in the decision making process, then they may engage in another differential analysis to determine if they actually made the correct decision. Then they may make another decision in order to remove the salad bar, or maybe to increase the prices, or something else. Now, as you've read the chapter, we illustrate the differential analysis for some very common decisions: leasing or selling equipment, discontinuing unprofitable segments, manufacturing or purchasing a needed part, replacing a fixed asset, selling a product or processing further, and accepting additional business at a special price. So now that you've seen the basic way that we create the differential analysis, let's talk about some of these different decisions. There's lease or sell. This is when you have a piece of equipment that's really no longer needed. This happens often when companies change their manufacturing process or they go and start creating a different product and they just can't use this certain piece of equipment in this manufacturing process. To make the decision, they would do a differential analysis. As we go through these, we'll actually show a differential analysis for each. So for lease or sell, we're looking at June 22nd of the current year. Marcus Company is considering leasing or disposing of this specific equipment. I want you to take a second and just look at the information that will be used in the differential analysis. You'll notice that they give you all of the pertinent information in regards to leasing or to selling. So here we have a differential analysis on that. If we were to lease the equipment, just let somebody rent it from us, we would have revenues of $160,000. There would be costs associated with the maintenance and repair, property taxes, etc. on the equipment of $35,000, giving us an income of $125,000. If we were to sell the equipment, have it all said and done, we would receive $100,000 for that equipment. There'd be $6,000 worth of costs in the sales commission, and then $94,000 worth of income or loss. Now, when we compare alternative 2, which is to sell the equipment, to alternative 1, we find that there is $60,000 less of income, $29,000 less of costs. However, overall, it would be $31,000 less of income. So when we look at only the differential revenues and costs associated with the lease or buy in the differential analysis, we don't take into account the $80,000 book value of the equipment because it's a sunk cost. You'll recall that on your balance sheet, there will be an amount for this asset. Sunk costs are costs that have been incurred in the past and they cannot be recouped and are not relevant to the future decisions. That is, the $80,000 is not going to be affected regardless of which decision is made. We'll go to an example exercise here at the next slide. Casper Company owns office space with a cost of $100,000 and accumulated depreciation of $30,000. It can be sold for $150,000, less a 6% broker commission. Alternatively, the same office space can be leased by Casper Company for 10 years for a total of $170,000 at the end, of which there is no residual value. In addition, there would be repairs, insurance, property tax that would be incurred on Casper Company on the rented office space, and that would total about $24,000 over the 10 years. So we're going to prepare a differential analysis as to whether they should lease, which is alternative 1, or sell the office space, which is alternative 2. Keeping in mind that the book value is a sunk cost, we put in the $170,000 worth of rental revenue. We have the $24,000 worth of maintenance and upkeep if we keep the property and we just lease it, giving us $146,000 of income. Now, if we sell it, we can sell it for $150,000. We have that $9,000 brokerage commission. That's 6% of $150,000. Would give us $141,000 worth of income or loss. So differentially, we're looking at if we were to sell the office space, we would see a potential loss of income of $5,000. Now I'll go ahead and I will break here and we will go to the next lecture, which will be discontinuing a segment or a product.